Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 249 for December 16th, 2019. This is the last Crowd Forecast News show of the year. So we are recording this at 1 p.m. Eastern Time. My name is David Kosmitter. I'm the creator of TimingResearch.com, and today we will be discussing the 325th report, weekly timing or Crowd Forecast News report. So be sure to go to TimingResearch.com/reports and either get the web or PDF version of the report for yourself and follow along with us while we're doing the show today. So I've arranged for John Thomas, Neil Batho, and Jim Kenney to be here. Neil hopefully will be joining us in a couple minutes, and John and Jim are here, and Jim will be moderating. So I'm going to go ahead and turn over to Jim.
Okay, thank you very much, David, and welcome everybody here to the show. We're going to have a lot of good stuff going on here today, and obviously the markets have been roaring, so there should be quite a bit to talk about. Before we get into anything, we're going to introduce the people that are with us here today. And first up is going to be John Thomas of the MadHedgeFundTrader.com. And he's no stranger to the broadcast. He's been with us many times. But for newcomers, John, could you tell a little bit about yourself and what's going on at Mad Hedge Fund Trader?
Well, for a start, I don't look anything like that picture on the screen. That's about 100 years old. Mm-hmm. Think of white hair instead. I do global long-short macro. We trade stocks, bonds, foreign exchange, commodities, precious metals, energy, and real estate, long and short. We're up 56% so far this year, and our average 10-year return is 36%. And if you want to get our free research, go to MadHedgeFundTrader.com and sign up at the free research box.
And of course, at the end of the broadcast, you'll have more of an opportunity to tell them a little bit more how to get a hold of you, and of course, any special offers you might have as well. Is Neil on the website yet, or not just yet? All right. So, John, we're going to jump right into it here because we got these markets rocking and rolling here this morning. So we opened up the S&P at 3183, SPX anyway, this morning. And so from today's opening, 3183 to Friday's close, first question is always, what do you think the market might do between now and Friday?
Go up.
That's an easy one.
We are in a classic end of cycle capitulation melt up, which can go on for months. What we're doing now is squeezing out every last short of the market and severely punishing those who had any doubts about the future of the stock market with their underweight position. So it's a mad scramble in the face of declining December liquidity. It's basically the mirror image of what happened a year ago.
Yeah, and it's a situation where positioning plus shorts are getting punished pretty darn hard right here.
Oh, absolutely.
On a confidence level, though, we are up at the higher end here. You do think it looks like it might go up here between now and Friday. And on a confidence level, what are you putting a percentage if you had to attach one?
100%. I mean, this is a liquidity-driven melt-up, and until we see a change from the liquidity situation, like the Fed raising interest rates, ending QE, it will continue.
Right. With regards to things that you're looking at reasoning on, again, you did mention a couple of them. Liquidity. I mean, obviously the central banks around the world have just been cutting. And, the Fed has thrown so much money at the short end that money market has collapsed again. And that forces people out of the money market and into the risk arenas more. And anything else that you're seeing that, because I guess I would ask, do you think the earnings this year and the revenues this year for 2019 were nothing to write home about at all? So would there have to be a big jump in earnings and revenue next year to sustain this?
No. When you have liquidity-driven markets like we had at the top of the dot-com bubble in 2000, right, like we had in Japan in 89,
right,
it is investment devoid of the thought process. You buy them because they're going up, and there is no other reason. Earnings actually are still falling. The economy is still shrinking.
Mm-hmm.
The trade deal that's been announced has essentially no substance to it. It just gets us back to where we were 2 years ago. Essentially what the trade deal did is it allowed us to stop hammering our own thumb with a hammer. So that might be worth 1,000 points in the Dow, but there's no fundamentals behind this whatsoever. We're looking for Q4 GDP of maybe 1.5%, which is going to be a multi-year low.
Are we using up quite a bit of the gasoline for 2020? In other words,
well, yesterday, or actually this morning, which said not only are we pulling forward performance from 2020, we also took a lot from 2018, and also because we came in at such a low level. So we're essentially getting 3 years worth of stock market performance this year. That said, don't expect a lot next year. I mean, the most bullish forecast out there is from Ed Yardeni, and that's for a SPY of 3,400, and we're at 3,200 right now.
Right. I saw JP Morgan was starting to question the 60-40 asset allocation, in that it had given you about an 8% return on average for the last 10 years. They were thinking that it might drop to something like 4, and it might be time to look at alternatives. What do you think about that?
Well, we abandoned the 60-40 ratio decades ago. It makes no sense anymore. Everything either goes up or goes down in unison. And if you have a big bond position now, it's going to give you zero protection if stocks go down next year. This year, both bonds and stocks went up. With dividends, stocks are up about 30%, bonds are up about 20. Next year, you can pretty much count on them both to go down at some point, but they're going to keep going up first. So the great shorting opportunity of a century is setting up. And by the way, Jeff Gundlach is saying, once we reach the top in this cycle, we won't see the highs again in our lifetime.
Well, if you looked at a chart, if you just fell to earth and you looked at a chart on the S&P going back 20 or 30 years, the first thing anyone would ask is what the heck happened between 09 and 19, because the chart is obviously inordinately going up one way.
And that's a really easy question to answer.
It's an easy question to answer.
That was the lost decade of the demographic drag.
Yeah.
That's when the big spending generation was only 45 million instead of 85 million.
Right.
It's pure demographics that caused that decade to go. Therefore, the next decade could be a golden age when the millennials take over as big spenders, because there are a lot of millennials. There are 85 million of those.
Right.
In fact, we have a research piece called, I have a book called Stocks to Buy for the Coming Roaring 20s.
And you think it'll be, the millennials will be targeting those particular stocks?
They'll be targeting everything: houses, stocks, precious metals, anything but bonds. And we finally get a return of inflation.
How do you feel about inflation for next year?
More or less, slightly higher. The last month's CPI was up 0.4. That's the highest it's been in several years. So we may finally be seeing a resurgence of inflation. And that could be, what ends this bull market is the inflation numbers taking off and interest rates following them.
That would be something that people are not prepared of, as they weren't prepared for short-term interest rates to be halved this year, right?
Yeah, we've had 2 months of really hot inflation numbers. So if that continues, then it's going to be game over. But it may take several months for the market to actually see it.
With regard to sectors, are there any sectors on the stocks that you're kind of keen to? I know you generally like tech.
We're focusing really on 2 sectors only. That's tech and biotech. Tech is the only sector of the market that still has decent earnings growth. It's about 20% a year. A year ago, the entire market had an earnings growth of 26%. So only tech and a few other things like biotech still have growing earnings. Everything else is a big fat zero.
On the tech sector, any names that jump out to you?
The bigger the better. We still love the FANGs, but then I'm kind of cautious. If I lose all my money, I'm too old to start from scratch.
Right.
But yeah, our target for Apple, has been $300 for ages, and we're almost there.
Now, this Facebook has had a difficult time taking out that 208 number. It's up today, but
but it's up 40% on the year. I mean, that's not, something to poo-poo at all.
But you think ultimately it will be taking that out?
Well, Facebook is a special situation situation. They seem to be, really hammering away at them on the antitrust front.
Right.
But all the others we love for the long term because they're still growing like crazy. I'd pick Google now over everything else. I was in Google headquarters last week, for my 9 o'clock meeting.
Right.
There were like 50 people lined up to get into the elevator. There are just people pouring into the building to do business with Google.
And that's making 52-week highs today at 1360.
Yeah, and we're it's our last long. We went into this month 50% leverage long, and we're just down to 2 positions now, Google and Microsoft.
Yeah, well, those certainly have been the performers, particularly Microsoft. Yeah, Microsoft has made another 52-week high here today at 156. Yeah. So,
we put on a bond short at the beginning of the month when Trump said it would take another year to get a trade deal.
Right.
That triggered a 1,000-point drop in the Dow. We just piled into that, long stocks, short bonds, and everything worked.
With regards to Amazon, what are you feeling there?
Amazon, unfortunately, is in the retail business, so they've kind of gone to sleep. I expect them to recover over the long term because they're moving into so many other businesses. I think eventually Amazon breaks itself up and gets a double on the valuation of the individual parts. But right now, I'm avoiding Amazon and sticking with the names I just mentioned: Apple, Google, and Microsoft.
It could be a situation where valuation has finally come and bit it in the butt, as it used to be way over 100 to 1 PE ratio, and now it's right in that 70s, and maybe it's a situation where people are just not willing to pay 100.
PE is kind of meaningless when you're talking about Amazon. You're really talking about future growth. But also in the last 3 months, ever since the WeWorks debacle, the focus has really shifted to money-making companies. And I think Amazon got hit with a little of that.
Is Walmart and Target getting into the online buying? More.
Oh, yeah, they're the next FANGs.
Yeah, because Target
especially has really done a fantastic job. 5 years ago, their online presence was a disaster. They were basically giving away the credit cards of all their customers to hackers. But they have really turned that around, and that's Walmart and Target are probably the only retailers you want to own. We don't expect anybody else to survive.
Yeah,
retail.
You got to be a discounter or an online retailer, or the Kohl's and the people like that.
Or working for penny margins like Amazon does.
Yeah. What about the semis? They have been on fire. Is that a fire that's going to go out anytime soon?
Eventually it will. This is the most volatile sector in the entire tech area. So we actually missed it this time because we were piling into more conservative positions in Microsoft, Google, and Apple. So do you want to own the high beta sector at the top of the market? Probably not.
And on the biotech side, are you trying to keep an eye on the bigger ones, or some of the ones
we cover the entire landscape. We have our own Mad Hedge Biotech and Healthcare letter, and among our recommendations have been Amgen, which is up 20% since September, and CRISPR Therapeutics, which is up 100%. So again, it's a risk tolerance issue. You can have a few small cap biotechs, but you have to be careful because one bad phase 3 trial and these things can give up 30-40% of their value instantly.
Yeah, and I was noticing that a lot of therapeutics have done very well, because some people are saying that the attack on prescription drugs would not affect the people who are making artificial knees and hips.
It doesn't, but it's a sentiment issue. Everybody gets tarred with the same brush. So if there's going to be a nationalization of the healthcare system, the whole sector will get slaughtered. That said, I don't think we're going to have a nationalization of the healthcare system. I think we're going to have both private and public options going forward.
Yeah, that makes some sense. The United Healthcare is certainly not acting like they're concerned anymore. Stock's gone from 208 to 300.
Yeah, and you can almost track Elizabeth Warren's poll numbers against the biotech sector. When her poll numbers peaked out in September, that's when biotech really took off, and the whole sector is up about 25% since September. That said, it could be topping out right here.
How do you feel about Pfizer? They got a hell of a nice yield, but it has lagged a little bit here. But today it's up pretty good, almost 2.5%. But is there something possibly worthwhile in Pfizer, in your opinion?
Well, it is definitely been in a uptrend since September when we launched our letter. And the problem is this is a pure drug company. So it would be much more affected by the U.S. government negotiating with drug companies individually, which is almost certainly going to happen in the next 2 years. But 34 to 39 in 3 months, it's better than a poke in the eye with a sharp stick.
Yeah,
the other drug companies.
And it's always nice to get paid to watch. It's nice to get paid to watch a movie, right?
Yeah, right. So yeah, it's lagging the market, but it's still going up. So
a couple of other ones as I'm just looking around here a little bit. Home Depot obviously went from 240 down to 210, and now it's turned up a little bit here. Is there something there of interest to you, or do you think everyone?
We like Home Depot long term,
right.
And I suspect this was tied to a slowdown in the housing market, which is going away. So we like Home Depot long term. We've been in and out of it many times over the years since it was in the 50s. And this is not actually a bad entry point right here, right above the 200-day moving average.
Yeah, this Lowe's obviously must be doing something to compete, because that's making new 52-week highs almost today, and has not had the pullback Home Depot has had. So I'm wondering if
the benefit of
finally putting a dent
Lowe's, it's much cheaper because it's not as good it doesn't have the same management as Home Depot does, and there is a lot of movement into this just as a laggard in the industry. So people are rushing for cheap stuff right now, and that's why the industrials are getting bids. That's why banks are getting bids. It's a rotation to cheap.
Now, obviously, JP Morgan is best of breed as far as the banks are concerned. Another 52-week high here today. But is there any other banks that you're finding interesting here that may have not gone straight up like this, and maybe has a little bit more upside?
We really haven't been participating in the banks ourselves because we have such heavy tech and biotech weightings.
Right.
So, you only have so much money. And the problem with JP always has been getting in at a good price, because it is best of breed. It is the best run bank in the world. It never really sells off very much. You do much better in a rally like this buying a crappy bank like Citibank, which will have a much bigger rally than a quality company. Citibank has gone from 60 to 77 since August. It's a much bigger move than JP Morgan.
It still hasn't taken out that 80 area, though. I think was 2018's high, something like that. But it's only a shot away. A couple of good days, it could take it out pretty easily.
But 35% in 3 months.
Yeah.
Who's going to argue with that? If you're looking for a cheap bank, look for Wells Fargo. But
I was going to say, I was going to mention that to you, John.
Cheap forever.
Yeah, I was going to say, is that going to be cheap forever? Because again, you're getting well paid to watch that movie at 374 or so on the dividend, and the PE ratio is at 11. I mean, is this?
It's also had a great run, like the entire sector. It's just Wells Fargo's main problem is that it's based in California, and you step over the line here, and you're a bank. They cut all your toes off. They really have no mercy for financials in California. It's probably the most regulated and overseen bank in the country, and that reflects
well underneath its. It's well underneath its highs from last year, which was like 65 or 60.
Oh yeah, it's got a long ways to go to new highs, but they have a lot of baggage to carry from past sins, and that's reflected in the share price.
And the other one that seems to be well discounted underneath its former high is Bank of America.
But they also don't have the growth and stability that a JP Morgan does. We actually bought this stock at $5 right before Warren Buffett went in and bought a 10% stake. I think the old high is 50. We're at 35 right now.
Yeah, 50, 55. Yeah, and it's at 35. So you would think if there's going to have a big future in the banking industry, this might be one of them.
But, it's another example of in a rotation like this, the worst run banks have the biggest moves because they're coming off of much lower lows.
Well, one of the big things people dust off at this time of year, John, and I'm sure you might agree with this, is that they dust off this is the year you got to get into emerging markets. So how do you feel about the emerging markets?
We actually like emerging markets quite a lot because we think the dollar has just completed a multi-year peak. And whenever you have a weak U.S. dollar, you want to pour into non-dollar investments. So that includes emerging markets, commodities, and precious metals. And with the debt growing at $1.25 trillion a year annual rate, that's going to kill the U.S. dollar. I mean, with the current budget, we're on track to have a $30 trillion deficit by 2025, and that will destroy the U.S. dollar and will be great for foreign investments, foreign non-dollar investments, and may eventually destroy the U.S. stock market too, is if foreigners really start pulling their money out in a meaningful way.
Hey guys, Neil is logging in now.
Oh, hey Neil, how you doing, bud?
Hey, Gary, I'm late for the show.
Oh, no big deal. Why don't you play catch up? You ready to play catch up?
Let's make it happen.
All right. Our next speaker here, Neil Batho, is here of TraderReview.net. Neil, obviously you've been on the broadcast before, but there are new listeners. For those who are not familiar, a little background on yourself, and of course a little bit about TraderReview.net.
Sure. I was a broker right out of college in 98, 99, and I had the best lunches I've ever had in my life when the mutual funds catered them in at lunch to try to get us to push their funds. And that was a dream for me. But I quickly got out of it because whenever I had a good stock idea, I'd have to call a client explaining the exact same thing to them every time. And it's just impossible to do so. So what we learned in our training is that they bring in people called $1 million producers. These are people that bring in $1 million of revenue to the firm, of which they'll get 40%. He said, you guys are not you're not financial advisors, you're financial counselors. And I thought, oh my God, I don't want to sit around holding people's hand all the time. So I got out of that, did some business consulting for a while, and started my website. And I used point and figure charting, which I actually learned in a webinar I did with some other brokers, and became an expert in that. And then I also use Ichimoku Cloud now to put together a tight knit portfolio for clients.
So let's get a couple of quick questions. We opened up today, I think, at 3183 on the S&P. And between now and Friday, what was your best guess on where we might end up?
I don't have an exact number to end up. I'm just going to say up.
Yeah, up. Okay, you think it's going to rise?
Yeah.
And you want to attach a percentage probability on it?
90.
Okay, well, John is at 100, so you got to play catch up here.
He's the bear today.
Yeah, he's the bear today. All right, so obviously,
you got to keep that 10% in case you lose it all, right?
That's right. That's right. So a little bit behind the curtain on what makes you think we're going to keep on running here.
You know, this reminds me back in 1999, the first time Alan Greenspan said irrational exuberance. And I think that was the first time the Fed ever spoke about the market, because supposedly they don't watch the market, even though they admit it now. That's basically all they do is the market. But back then, they were always talking about, full employment, low inflation. Now the Fed doesn't give a damn about inflation. It causes massive inflation. And you have to keep working because you can't keep up with the damn inflation unless you put the money in the market. You can't put the money in the market fast enough. So how's that for full employment?
Yeah,
you know?
Yeah. Well, again, that seems to be the common thing here. I was wondering, when you do your point and figure and other type of technical analysis, we're in uncharted territory, right? So is there any type of a tool you would use to give you a guesstimate on where exhaustion could occur here? Like what level on the S&P is there potential that could stop the music a little bit here? Or there's no way to tell when you're in uncharted territory. Nothing. You have to wait for a formation.
It's uncharted territory, just like in 99. Everyone said stocks are overvalued, or even going back 1996 was when Greenspan said irrational exuberance, and stocks didn't crash until 2000. So we literally have 3 more years to go. And back then, a lot of people were saying, I don't want to buy stocks, they're overvalued, and they missed out huge. But I do look at the PE, S&P 500 PE. I got to look at that chart again. It probably broke out. You just type in S&P 500 online, you find it. And we are already at the top of the 100-year range, aside from that 2000 spike and the financial crisis spike, which really screwed up the PEs for a couple quarters. But the only thing I would say is if there's a big down day, like Dow down 500, it's just easier to say Dow instead of S&P.
Right.
I would down 500 one day, up 380 the next, get out.
Now, anything on the point and figure charts or any of those technical analysis that have any type of, Fibonacci number or anything that gives us any kind of a number in the upside that could cause that could be a target?
No.
Nothing like that.
There's the bullish percent index, and that will measure the percent of stocks on a near-term point and figure buy signal, right? And so I haven't looked at that for the last couple of days, but it's probably going to be almost near a peak. And so once that gets up to, I think the most it's ever been is 90 in the S&P 500 in New York Stock Exchange. So if that hits 90% of all stocks in S&P 500 or New York Stock Exchange are on a near-term point and figure buy signal, I mean, you can forget it. And I mean, also you got to look at the small caps, because small caps break down before large caps. So yeah. I would look at that too. But I mean, there's an economic term. A lot of people do it by instinct, but other people have to learn it, and that's opportunity cost. So what's your opportunity cost if you miss out on something? Like in 99, why didn't you buy internet stocks? I mean, it's opportunity cost just lost. So
yeah, because your cleaning lady was buying them.
oh yeah, that's another awesome one. And I'm kidding, not joking. If you get in a cab and the cab driver says, I just opened up a brokerage account, I can't wait to start investing, you get the hell out as fast as you
Yeah, my piano tuner was
it's
asking me last week if he should be buying stocks now.
Sorry, what?
My piano tuner.
Did he really?
It was asking if he should buy stocks, and I said no. In fact, if you have any stocks, I'd be selling them now.
Well, if he didn't actually open the account, I think we got a few more weeks.
Yeah, right.
Once the money is deposited into the new account, then it's just a couple days.
Yeah, right.
Now, John, you've been involved a bit with the biotechs and things, and the Russell is pretty much weighted towards biotech and financials. It's at 1656 right now, but it's still about 1,000 points or so underneath. It's 100. Excuse me, not 1,000 points, 100 points or so underneath its 2018 high. So, is this a situation where it'll ultimately blow out that high, or do you think this might be a little bit of a high point? John,
Say that again.
I said the Russell, which I think has a lot of biotech and financials in it, of which you're, obviously in the biotechs quite a bit.
Actually, the IWM is very heavy in small energy stocks. That is the largest single sector in the IWM. And yes, they always do worse in falling markets because they are not financially as strong as other companies. So when you saw that breakout above 160 in the IWM,
right,
that was your clue that the entire market was about to break out. We got that signal in the beginning of October. We only play the IWM on the short side because it drops twice as fast in falling markets as the S&P 500.
Now, Neil, are there any stocks that you're looking at that you'd like to share as far as things that you think might have some potential?
Anything solar.
Okay.
TAN is the ETF. You got Solar Edge. You got a bunch of other ones. A lot of these left-wing governments are going to try to stay in power, so they're going to want to do solar stuff. And also, solar goes the same direction as the price of oil. Oil just broke out at 60, or it's hanging out a little above 60, trying to move higher. So I think solar is going to be a good place to be, at least for maybe 3 to 6 months. It's a pretty volatile sector. And I think a big hidden surprise for next year is going to be oil. I mean, I was thinking about yield recently, and no one thinks that in bull markets like this, but Exxon is yielding 5%, if you can believe that. And
don't expect that to stay at 5% for very long.
Well, they've raised their dividend for 10 years straight, so either the stock's going to rally and the yield will go down, or I don't know what's going to happen. That seems...
Yeah, but they borrow to meet that dividend, and that's almost always a bad idea.
What about the other guys, British Petroleum, Royal Dutch, Chevron? What do you think about that, John?
We think the whole oil industry is going to zero. That's why the Saudis sold off Saudi Aramco. And when Saudi Arabia wants to get out of the oil business, you probably should too. Not only are we getting massive overproduction from the U.S., but you're also getting falling demand from the rest of the world, especially China. On top of that, you can add the big switch to solar that's going on. And one thing I did want to mention about solar, if the Democrats win the election next year, you can expect a whole raft load of new subsidies for alternative energy. And by the way, the biggest beneficiary of that, can you guess? Who would be the biggest beneficiary of a pro-alternative energy policy from a new administration? Anyone want to take a shot at that?
Not enough time to think.
Jim Kenney, how about you?
I thought Tesla, because Tesla seems to be going to the roof again.
It's Tesla. You've nailed it. And that's why Tesla has doubled since June.
Yeah.
You can almost track Tesla stock against Democratic prospects in 2020. And the better the Democrats look, the better Tesla looks.
Yeah,
so,
I mean, clearly it's made a 52-week high today. And just in the last, month, it's gone from 250 to 350 or something like that?
Yeah. And if we hit 400 in Tesla, it'll go to 600 in a heartbeat. So we've been following this company since it was $16. I've owned Teslas for 11 years now, and this is one stock where it has a shot at going up 10 times in the next 5 years.
I saw something.
One of the few 10-baggers out there, other than some biotech stocks.
I saw something in Musk's contract from a year ago or something where he gets a huge bonus if Tesla's stock market market cap reaches something like 600 or 800 billion, you'll get some massive.
Well, he's at 64 billion, so he better go to work.
Yeah,
10
well, and he
10
owns
times to
20%
go.
of the company. So if the stock rises tenfold, just his current share ownership goes from 10 billion to 100 billion. I don't think he's worried about money. Just, if he makes that much money, it just means we'll get to Mars faster.
Short interest is at 16% of the stock, so there's got to be a couple of people with band-aids
And that's down from half. It was
Yeah,
you gotta be in
35% in June was the short interest in Tesla.
You watch the commodities at all, Neil, or not too much?
Yeah,
Okay.
I'm bullish on agriculture. We actually hold DBA, the agriculture ETF.
Yeah. John, I know you're watching it as well. Any commodities that you're finding to be ones to keep an eye on?
You know, we used to cover commodities and gave up because we decided it's in a secular long-term bear market because of the productivity of the U.S. farmer. Prices, just keep going down, down, and down. So, and this year you had the particular complication that it was all affected by the trade war with China. So, I think you're getting a dead cat bounce rally, a relief rally in all the eggs. But once that works its way through the system, there's nothing left there.
Yeah, one market that I've been focused on watching here is the soybean oil, which seems to be really on a good run here. It's up again today, and it's
we watch soybeans, the SOYB, and that moves almost perfectly with trade war outlooks.
And they were saying that the money that the farmers got was not put into equipment like Caterpillar or John Deere, and so
No,
maybe
it was banked.
It was banked and payoff loans. And so I don't know if that sets up to a tighter supply next spring or not. But if it did, and the orders came in from China, the moving averages seem to be turning to the upside on some of the soybean products. It could be an interesting year in 2020 for the soybean oil and soybeans themselves.
Right, but the moving averages of every asset class in the world are now moving up, no matter what you look at. And I think, a big chunk of the soybean market here in the U.S. has been permanently lost to Brazil. China replaced American supplies with Brazilian supplies, and a lot of that is permanent. It's not coming back because the U.S. is an unreliable trading partner, and they call them nasty names too.
Yeah, I see a couple of other commodities have had good runs, sugar and coffee as well. So some of the boards, seem to be turning a little bit. I mean, and I was looking at a couple of funds. What's the one that you were talking about, Neil?
DBA.
DBA, yeah, it's awesome. There's also a Rogers one. Jim Rogers has a commodity fund, or he used to. You could look that one up too, pretty similar.
Yeah, it's because that seems to be trying to move to the upside here as well. But this is mostly in ag. Huh?
Yeah, remember when Jim Rogers said you should trade your Ferrari in for a tractor? After he said that, ags went down for 7 years straight.
I don't know. I don't follow him his every move. But I was looking at. I thought it was kind of interesting this year in 2019 that Vanguard came out with a commodity mutual fund, and under the possibility they've done some research, it might let one know that there could be some opportunity there.
Vanguard and research is a contradiction in terms. The whole point in buying a Vanguard fund is they don't do any research, and therefore they can keep their costs down.
Yeah, they're indexing. They're indexing to the Bloomberg index or something like that, I believe. I'm not 100% sure.
Yeah, unfortunately, with ags, your tracking error is going to be much greater your tracking error is going to be greater than it is for stocks, which are much easier to hedge.
Yeah, the broad-based index, the Bloomberg Commodity Index, has oil, grain, metals, and softs in it. So there's some diversification, but different weightings.
Yeah, the trouble with all these non-interest-bearing securities, they have huge contangos. So you can be right on the direction of the commodity and still lose money on your ETF.
Hey, Neil, what's your opinion on interest rates? The TLT, which is a proxy for the 20-year Treasury, ran way up towards 150 as everyone was panicking in, and everyone on TV is going, zero interest is coming. And now it's at 137.72. Is this thing going to take out 135 and yields are going to rise? Or is this a situation where it's a pause before the storm to lower interest rates?
I haven't actually been thinking about bonds much at all the last week or so. The the reason is because the big money is over in bonds. You had to get that massive trade earlier in the year, which we did. I think there were 2 times. You could have had there were 2 times this year. You could have made huge gains on bonds as they rallied. But the only reason people want to be in bonds is, well, they rallied mainly because they were undervalued and perception that rates would not drop much anymore. But now it's over. I think the game is over for bonds. This is nothing to play.
Yeah, but I mean, is it over and we're going to go flatline, or is it over and people are going to be very surprised that yields rise much further than they thought?
So by yields rising, you mean that?
I mean, like the 10-year Treasury went down to 140, and now let's say it's 185. Most people, I mean, I listen to Real Yield on Bloomberg every week, and most people are saying 1.5% to 2% is going to be the window on the 10-year for 2020. Of course, last year when we were at 3% in December, I'm sure they weren't saying we're going to go down to 1.5%. So obviously, listening to the talking heads is not always the greatest idea. But since most people are not really saying that the 10-year can get above 2 or 2.5, do you think there's any possibility of seeing that?
I'm just looking at the chart here, and it's a nowhere play, anywhere from sideways to down. Of course, if stocks crash, in March, which is the same in 2000, we could have bonds rally for at least a couple of weeks. So keep your eye on it for a nice pattern to rally. I mainly just look at TLT instead of looking at the yield.
Yeah.
But we've been shorting bonds since August.
That game is over. It's just not worth it for me. What's interesting though, I remember a couple of years ago looking up, I was wondering what are German bonds yielding, and they yield nothing at all. I think you lose money if you buy. It's like a negative yield.
No, you have to pay to own German bonds.
Yeah,
the negative yield has come way down from negative 95 to about negative 10.
So I don't know why Germans do that. I guess it's just because they're German, but why don't they just buy U.S. bonds? It makes no sense to me at all. But maybe it's hard to do it over there.
Well, they're not allowed to, buy foreign bonds. The institutions who buy at negative 95, they're only allowed to buy German bonds. They're German pension funds and those sort of things.
And central banks are pretty much the buyers of a lot of that stuff too, aren't they?
Basically, all the debt in Europe is now owned by central banks.
That's right. Yeah.
That's why they can't do QE anymore. They own everything.
Yeah, the thing is there's been an explosion of debt, corporate debt, sovereign debt, municipal debt, you name it. And you just wonder, if you're familiar with bonds, they're not exactly the most liquid things in the world if there's a redemption run. And ETFs kind of seduce people thinking they're into some kind of liquid investment just because they have $1 price on it every day on the newspaper. So, John, do you see any risk to speak of that a redemption run into debt, be it corporate or whatever, be a disruptive factor?
Well, when we go into the next recession, which could be 1 or 2 years from now, spreads will absolutely blow out. Right now, they're minuscule. People are reaching for risk to get a few more basis points in income, and that also is a sign of a market top. But when we get into the next recession, whenever that is, then you could see U.S. rates down to 1% for the 10-year. By the way, German governments, I just looked them up, negative 27 basis points. So that's a huge improvement from negative 95 in August.
Hey, Neil, you were talking about the solar as something that you're keeping an eye on. And I was wondering, are you doing anything with these precious metals at all? Or do you think that was a big run that occurred and that run is over? Or do you think it's a pullback and it'll have a decent 2020?
I think gold is over. Don't even bother. There's just no point whatsoever anymore. I mean, 1,500 is still a lot. Picture a gold coin in your hand. It's just not going to be worth $3,000, at least not for 15, 20 years. So that play is gone. That was a war play starting in 2003. And we made so many trades. I can't even count how many trades we made successfully on gold and silver as well. But don't even bother. I mean, stick to other commodities. Lithium stocks. There's an ETF called LIT, which I like. It's actually not lithium miners. Mostly it's battery companies, but that's been going quite well lately. I like lithium. I like solar. I'll keep my eye on oil, even though some people here don't like it, but maybe it can still sneak up. I mean, because you got to use gasoline powered trucks to dig up the lithium to make electric cars.
And so the LIT is some way of trying to participate into the battery future of electronic vehicles, et cetera, et cetera.
Yeah, I don't know a lot about about it. I've just been tracking it, and I looked.
Yeah, I mean, if it's a momentum play, obviously it's had good momentum since earlier in the year when it hit 23, and it's been kind of moving to the upside.
Solar is one of my favorite picks because everyone around the world is feeling guilty for even breathing the air these days. So you go for some solar stocks. TAN, the ETF is okay. The big one is First Solar, and if you do research, maybe you'll find some other small cap ones that they could go up 100% next year. Some of these.
Yeah, you like the idea of solar, and you like the idea of the lithium as well, huh?
Yeah, and I still got my eye on oil. I mean, we're actually long oil, the ETF oil. We're up a few percent. We got it.
It is. Hey, listen, it's been creeping up, and a lot of the stocks, Schlumberger and Halliburton, and those, they certainly have gotten a bid behind them in the last 3 months. There's no doubt about that, right?
I mean, inflation goes into everything. It goes into commodity prices, it goes into stock prices, it goes into oil prices. And oil at $60, considering all the money printing that's going on and inflation, is actually pretty cheap. Considering a burger, fries, and Coke has doubled in the last 8 years or so, and your gasoline hasn't, says something, So the inflation just hasn't been going into the gasoline and oil prices very much. And, we could see by the end of next year, oil at 90. It doesn't mean...
I mean, obviously, things can happen in energy that can surprise people, that's for sure. John, with regards to China, you follow that quite a bit. They're going into Africa to do development, and they're going into Europe and all over the place. And some people are thinking that their demand or their need for copper is going to be very significant. Do you see an opportunity in Freeport-McMoRan, or do you think...
Well, we've been recommending it, since it was single digits. And Freeport-McMoRan is just a play on the recovery of the global economy. And right now, markets, having discounted a recession going into July, August, are now backing that recession call out of the market. So Freeport always does well in that situation. We actually piled into some long-term leaps at the bottom of the copper market, and they basically have doubled their money on those since.
Yeah, they were probably dirt cheap at that point, huh?
Oh, yeah, they were just throwing them away. So, it could move to 20 on this move, but, I think it's too late to chase Freeport right here at $13.
Yeah, it could be due for a little bit of a pullback, but maybe the pullback might not be a bad thing to look at around 12 or something like that.
Yeah, by the way, on gold, if the time to buy gold is when the S&P 500 hits 3,400, which will probably be the high next year. If we don't hit it this year first, then stocks will be way overbid, and you'll get a great risk-off play in gold. And we're waiting for that to happen before we go back into gold.
Yeah, I was listening to Marco Kalanovic or something from J.P. Morgan. He's, I guess, a quant guy.
Yeah,
and he was using a target of about 3,400 or so for next year for him as well. So
yeah, a lot of people, and that's the bullish end. That's the high end of forecasts, and a lot of people are gravitating around that number, which, by the way, would take the PE multiple for the S&P 500 up to 20 times, which is a 20-year valuation high.
Yeah,
that's why they're hitting on that number, and that is historically the worst place of the century to own stocks. Anything over a 20 multiple.
The other thing is at the end of the year here, corporate buybacks. I had read that there has to be some done before the end of the year, so maybe there's a little bit of a squeeze on those people as well if they have to buy back stock before the end of the year. Maybe that gets out and people are just pulling their bids.
Pulling
their offers.
Those are Apple and the other big tech stocks. That's why I think they're going to melt up into the end of the year.
Yeah, because
I'm getting like 10 emails a day saying, "Is it time to short yet?" And I say, "No, this could run till year end."
Yeah. And again, stepping in front of a freight train never was healthy, and there's no formation to trade against other than Infinity right now, because you're in uncharted territory. So this is not a place where you could do too much predicting based on technical analysis, other than things are overbought, which is not exactly a conclusive signal. Anything else you guys are looking at that you might want to cover? What about Europe, John? A lot of people, again, they're at the end of the year, so they're pounding emerging markets. You think there could be some value to that. They're also pounding the table that Europe might be a place to go.
Again, Europe has been doing well. That's another weak dollar play. So if you believe that the United States is going to continue to borrow money and weaken the dollar, then yeah, you want to own Europe as well as emerging markets. Also, you have Brexit out of the way now. It's basically a done deal with this election last week, electing Boris Johnson, even though he's an idiot. So
he needs a comb. That's what he needs, a comb, right?
Yeah, and some principles would also do well. Journalists that lie for a living don't earn a lot of points with other journalists, and Johnson was notorious for that. But anyway, you get all these unknowns out of the way. That's worth another 10 or 20% in Europe. And like I said, it's like shooting fish in a barrel right now. All asset classes everywhere around the world are going up now.
Right.
It's a total global risk-on move, totally liquidity-driven.
How do you feel about Lagarde at the ECB?
Well, so far she's done nothing, but so no one really knows what's going to happen. But with everything recovering, bond yields starting to rise again, stock market's going crazy, there's not really much you need to do.
The PMIs in Germany slipped today when they announced them.
Yeah, but generally the German data has been improving for 3 months now. I mean, it was diabolical last June.
Yeah, the Chinese data was quite good today.
Yeah, and again, that is front running a trade deal, and once that works, it's through the system, then we'll see what China can really do.
Hey Neil, anything else on your radar stock wise? Because a couple of the ones you mentioned have definitely seen some good momentum. Anything else besides the couple of three that you talked about? Neil? Hello, Neil?
I think he got knocked out of the room somehow.
Oh, he did?
I'm still here.
All right. I guess he'll come back in once he gets reset.
So let me tell you how to make money in stocks in 2020.
Yeah, he's logging back in now.
He is? Okay. So, well, John, I'm going to start with you. Is there anything else that you wanted to bring up? And, of course, any offers you wanted to extend at the end of the broadcast here to the listeners?
Well, you can sign up for our free research by going to madhedgefundtrader.com. There you sign up for free research. You get something called Mad Hedge Hot Tips, which is the 5 most important thing you have to do every day. And that's in your inbox right when the market opens. So that we give away for free. And then if you like us after that, if you still like us after that, then we have more advanced products to offer more sophisticated traders. Our long-term forecast for the market is Dow 120,000 by 2030. That's a 4-fold increase from here, and that's exactly what we've done over the last 10 years, was a 4-fold increase. You trade around that in the right way, you can make triple that return. So madhedgefundtrader.com is where you go, and I'll look forward to working with all of you.
That's great. Thank you very much, John. And Neil, are you back on?
I'm back.
Okay. I just was asking you before you cut out, you had mentioned some solar in a solar area and in a lithium area. Were there any other particular areas that you're kind of keen on, and any kind of stocks that you're following?
Yeah, also copper. I also like Freeport McMoran. We hold that, and we also have alls. Yeah, it's really good.
Yeah, because again, the copper does seem to have a bid. Again, the demand is supposed to be pretty good out of China, and obviously with the economies possibly turning the way everyone's betting anyway, the demand for copper you would think might increase as well, right?
Yeah, it's a good bottom fish play too. You need copper, so yeah, I like it.
All right, well, Neil, you again came in a little bit late, so again, if you want to just make sure everybody knows how to get a hold of you, and also if you have any special offers or ideas that you want to share, this would be a great time to do that.
Yeah, sure. You can sign up at TraderReview.com. I'll give away the best fundamental ETF to hold the next 10 years. Beats the market just about every year if you're into fundamentals, and you get my free newsletter I send out a few times a week. Overall tasks.
And do you have a chat room or anything like that, or do you have sometimes a seminar you give or webinar you give?
I'm not doing webinars right now, but I might do it in the future.
And any kind of what do they call that? Coaching or anything like that a little bit, or is it pretty much just whatever you put out?
No, I don't do personal coaching. No.
I gotcha. So you have a way for them to get the ideas that you're looking at, and like I say, the ETFs that you think might look good, and people can get that kind of information by going to TraderReview.net, right?
Yeah.
Okay. All right, guys. Thanks a lot. I think we covered an awful lot here today. There's a lot to cover. Markets are on fire, going nuts, and Obviously, all-time highs, uncharted territory. So it's an exciting end of the year rush that we're seeing. Again, good to have John Thomas of Mad Hedge Fund Trader and Neil with us. And again, thanks everybody for being here. I'm Jim Kenney, option professor at gmail.com if you have any questions for me. But right now it's top of the hour, so I'm going to turn it back over to David.
All right, thanks guys. Great discussion. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory. You can also go to TimingResearch.com and get access to any of the past reports or shows, including the archive of this one as soon as I can get it posted. And be sure to join us tomorrow for Analyze Your Trade, episode number 106. Matt Buckley will be back for that one, and Jim will be moderating again. And as I mentioned at the beginning, this is the last episode of the Crowd Forecast News Show for the year. So we'll be back on January 6th for that. But like I said, Analyze Your Trade we'll be doing tomorrow at 4 p.m. Eastern Time. So you can get access to that at TimingResearch.com/live. And I just want to thank my guests again for today's show. So John Thomas of MadHedgeFundTrader.com, Neil Batho of TraderReview.net, and Jim Kenney of OptionProfessor.com. Thanks, guys.
Thanks, David.
Thanks, David.